If you thought the gold market was heading straight to the moon, you just got a wake-up call. We are witnessing a classic bull trap that has left thousands of retail traders holding the bag. On Thursday, spot gold didn't just drop, it was rejected, violently. After testing a critical retracement zone, the market slammed into a wall of profit-taking, wiping out gains and turning the weekly chart red. The number you need to remember is 5,091, 93s. That was the line in the sand. That was where the sellers were waiting. And now the questions are flooding in. Is the bull run over? Was this just a shakeout? Or are we staring down the barrel of a much deeper correction toward 4,147s? But this isn't just about lines on a chart. This is a global story. We have the US dollar flexing its muscles again. We have the tech sector selling off, sparking risk aversion. We have the Reserve Bank of Australia hiking rates when everyone else is pausing. And we have a Federal Reserve governor dropping hawkish bombshells about 2026. Today, in this comprehensive breakdown, we are not just going to tell you what happened. We are going to analyze why it happened and exactly how the smart money is positioning themselves right now. We are going deep into the technicals. We are going to calculate the exact Fibonacci clusters you need to have on your screen. And I'm going to show you why a specific triangle pattern forming over the next few weeks could be the most profitable setup of the year. Buckle up. The speculative tree has been shaken. It's time to find the value. Let's dive in. Let's start with the immediate price action. Why did gold crash on Thursday? The headline answer is profit-taking. But that is a lazy answer. We need to understand where that profit-taking happened to understand what comes next. Look at this chart. Earlier in the week, following the steep sell-offs we saw on Friday and Monday, gold attempted a recovery. This is what we call a dead cat bounce, or a retracement test. The buyers stepped in, pushing the price up into a critical zone. Our analysis identified a potential resistance zone between $5,002.31 and $5,143.89. This wasn't a random zone. This is where the bears were hiding. Gold rallied right into the heart of this zone, hitting a high of 5,091.93. And what happened? It didn't break through. It didn't consolidate. It got swatted down. Sellers stepped in aggressively. This specific price action, a rally into resistance followed by a sharp drop, tells us one thing clearly. Technical traders have regained control. For a while, the market was driven by hype, by speculation. But when price respects these mathematical levels so perfectly, it means the algorithms and the professional swing traders are now driving the bus. The article we are analyzing today puts it perfectly. The speculative tree has been shaken. Imagine a tree full of loose fruit. That fruit represents the weak hands, the retail traders who bought high because of FOMO, fear of missing out. When the market drops sharply like it did on Friday and Monday, it shakes the tree. The weak hands panic and sell. Now the market is lower for the weak. The speculation is gone. And what are we left with? We are left with a search for value. This is the phase we are entering now. It's no longer a vertical lineup. It is a grind. The market needs to find a price where the big institutions, the whales, feel comfortable buying again. They didn't want to buy at $5,091. That was too expensive. They are looking lower. They are looking to build a new support base. And as we will discuss later in this video, that base looks like it's forming around a very specific number, $4,147. You cannot trade gold in a vacuum. If you are only looking at the gold chart, you are trading with one eye closed. To understand this drop, we have to look at gold's nemesis, the United States dollar. Short-term fundamental analysis shows traders are eyeing a rise to a 2-week high in the US dollar. Why is the dollar rallying? There are two main engines driving this dollar strength, and both are bad news for gold in the short term. 1. The tech sector sell-off. The stock market has been weak. Specifically, the tech sector is bleeding. When stock investors get scared, when they see their portfolios turning red, they flip a switch in their brains. That switch is called risk aversion. They sell stocks. But where do they put that cash? Do they put it in gold? Sometimes. But usually, in moments of immediate panic, they run to the ultimate liquidity, the US dollar. When risk aversion hits, demand for the dollar spikes. And since gold is priced in dollars, a stronger dollar makes gold more expensive for foreign buyers. This crushes demand. The weakness in the stock market basically handed the dollar a megaphone, and the dollar used it to shout gold prices down. 2. Nervousness, ahead of central bank decisions. The second engine is uncertainty. We have major rate decisions coming up from the European Central Bank, ECB, and the Bank of England, BOE. Now, the consensus is that they will leave rates unchanged. So, why the nervousness? Because the market doesn't care about what they do this week. The market cares about what they say. And speaking of high rates, we got a nasty surprise from down under. Earlier this week, the Reserve Bank of Australia, RBA, hiked their cash rate by 25 basis points. This is their first hike since November 2023. Why does a rate hike in Australia matter to a gold trader in New York or London? Because it sets a precedent. It signals that the war on inflation is not over. If Australia is still hiking, who else might need to hike? This shattered the pivot party narrative that central banks were done raising rates. But the biggest elephant in the room is, as always, the Federal Reserve. The debate in the US has shifted. We aren't just talking about 2024 or 2025 anymore. The market is now arguing about the timing of the first Fed rate cut in 2026. And late Wednesday, we got a comment that sent shivers down the spine of every gold bull. Federal Reserve Governor Lisa Cook gave a speech. Now, usually, Fed speeches are boring. But this one had teeth. She explicitly stated she is more concerned about the lack of progress on inflation than she is about a weakening job market. Do you understand what that means? The Fed has a dual mandate: keep prices stable, fighting inflation, and keep people employed, jobs. Usually, when the economy slows down and jobs get scarce, the Fed cuts rates to help. Lisa Cook is saying, I don't care if the job market weakens. If inflation is sticky, I am not cutting rates. To predict where gold goes next, we have to understand the mechanics of the crash we just witnessed. The article uses a very specific phrase, long liquidation. Now, if you are a beginner, you might think selling is selling. But to a professional, there is a huge difference between short selling and long liquidation. Short selling is when bears enter the market to bet against it. They are aggressive. They want the price to crash. Long liquidation, however, is when the bulls, the people who bought gold, are forced to exit. Imagine a crowded theater with only one exit door. Everyone is happy watching the movie, the price going up. Suddenly, someone yells, "Fire!" Bad news or a technical break. Everyone rushes for that one exit door at the same time. That is long liquidation. It's a cascade of stop-loss orders being triggered. The article states, typically, the first leg down from a major top is primarily long liquidation. This is crucial because long liquidation is usually temporary. It washes out the weak hands, the leverage, and the latecomers. Once everyone who needs to sell has sold, the selling pressure evaporates, and that is usually where the bottom forms. In this case, that panic selling drove the price all the way down to a specific low, $4,402.38. This wasn't a random number. This was the point of maximum pain, where the liquidation finally stopped, and the smart money stepped in to catch the falling knife. Now, let's get technical. The article mentions that there are no surprises here for swing chart traders. Why? Because gold is following a textbook pattern. If you want to trade like a professional, you need to have these specific zones marked on your chart. Let's draw them together based on the data we have. During that first leg down of liquidation, the market tested a massive retracement zone between $4,144.34 and $4,541.80. This zone is what we call the battlefield. The bulls tried to defend it, the bears tried to break it. And look right here. We also had the 50-day moving average at $4,531.05. The 50-day moving average is the institutional line in the sand. Hedge funds and pension funds use this line to define the medium-term trend. If the price is above it, they buy. If it's below it, they sell. The fact that gold pierced through this zone and went as low as $4,402 tells us the selling was intense. But, and this is the key, the close of the candles and the subsequent bounce tell us that buyers are still lurking in the deep waters. So, we established a bottom at $4,402.38. Then we had the bounce, the rally, the hope. We rallied all the way up to test the resistance. This is where the math gets beautiful. The article highlights that on Tuesday and Wednesday, gold retraced to a potential resistance zone at $5,102.31 to $5,143.89. Why these numbers? Again, it's Fibonacci. This is likely the 50% to 61.8% retracement of the crash. The market rallied, hit a high of 5,091.93s and stopped. It didn't reach the top of the zone, 5,143. It stalled right in the middle. This failure at 5,091 point is the tell. It tells us that the bulls ran out of ammo. They pushed as hard as they could, but they couldn't break the sell wall. When a market fails to break the 61.8% resistance, 5,143, and rolls over, it signals that the trend is still technically down. So, where are we now? The old highs don't matter anymore. The old lows don't matter. We are in a new minor range. This is your playing field for the next few weeks. The ceiling is 5,093. The floor is 4,402.38. We are currently falling from the ceiling. So, where is the target? Where will the price stop falling? The article gives us a very precise, very dangerous number. The 50% correction of this new range, the exact halfway point between the high and the low, is $4,747.15. But it gets more interesting. In trading, we look for confluence. We look for multiple reasons to buy or sell at the same spot. One number is luck. Two numbers is a coincidence. Three numbers is a trade. The article points out a support cluster. We have the 50% level of the current range at 4,547.15s. And we have an older 50% level from the previous structure at 4,744.34. Do you see that? The difference is only $3. In a market that trades at $5,000, a $3 gap is microscopic. This is a sniper target. This 4,747th area is what I call the kill zone. This is the next downside target. If you are short, this is where you take profit. If you are long, this is where you pray the buyers step in. Because if this level breaks, if $4,544 gives way, there is nothing stopping gold from retesting the absolute lows of $4,400. Let's step away from the math for a second and talk about the people pushing the buttons. The psychology of the market has shifted fundamentally this week. The article uses a phrase I love. The speculative tree has been shaken. What does a shaken speculator do? They become timid. 2 weeks ago, traders were buying every dip blindly. Gold to the moon was the chant. Now, they are scared. They have taken losses. They have seen their profits evaporate. When speculators are shaken, they stop chasing the price. They stop buying breakouts. Instead, they wait. They sit on their hands. This reduces liquidity. It makes the market choppy. This leads us to the prediction for the next few weeks. The triangle. The article states, over the next few weeks, we could see a triangle form as traders sell rallies and buy dips. This is classic market behavior after a crash. The market contracts. It goes up, but not as high as before, lower high. It goes down, but not as low as before, higher low. It coils like a spring. Why is it coiling? Because nobody wants to make the first move. The speculators are too scared to bet big, and the institutions are waiting for one thing, the Federal Reserve. Until we get clarity on Fed policy, specifically that 2026 rate cut debate we mentioned in part 1, the market is likely to trap both bulls and bears in this tightening range. So, how do you trade a market that is scared, shaken, and waiting? You don't chase. You become a sniper. You wait for the extremes. You wait for $5,091 to sell. You wait for $4,747 to buy. Anything in the middle is just gambling.